after a pretty somewhat sharp decline going into the close on Friday, the market was able to kind of withstand that and kind of just ended up with a really quiet day. We got a couple big news items coming out here this week with the CPI on Wednesday and the beginning of earnings season across multiple sectors after Thursday's close and especially before Friday's open. So the market taking a breather. Monday's barring an unexpected news event, Monday tends to be a pretty much a breather for the markets, and that was definitely the case today. So we're going to kind of break down the moves that we saw today, and there was some moves that were not breathers. There were some outlier moves. So we're going to talk about what they were and why they happened and what significance it has, what our expectations still are going forward into this next few weeks as we head into a seasonal low for volatility. So we're going to break all that down, what we expect to see from volatility in the next so many months. And then we're going to take a look at our trade idea in this kind of volatile XLK technology sector, not being caught up with the rebalancing news, the NASDAQ 100 rebalancing news. So we'll talk about its move. It's had an interesting move, especially over the past month, and then how we can trade that move. So let's go ahead and get started. Today is Monday, July the 10th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, come down here to the bottom, check out some of these other things here over here on the right, like the Market Outlook Live, where we do the trade idea before the market closes. Come down to the bottom, click this heart, it opens up this tab, hit that like button. Same thing here, click the thumbs up icon, it opens up another new tab, hit that like button there. Again, that's a really great way to help us get our content out to all of our followers on those platforms. That's why we always ask for it. Our goal is to get to 100. We got a lot closer this time than the last few videos, so thank you very much. For those who are liking these day in and day out. Those who aren't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator like we generally do. And you can see we continued this little pullback. We were up about, what, 0.25% today. Not very much, but still kind of at the low end of this range of this near-term decline. It actually brought both the near-term line and momentum lines higher, but not high enough to keep them out of the bearish territory. So there's still, the intermediate confirmation signal, that bullish short-term signal we talked about, have played out today with small bullish bias here, but not, again, like I said, not bullish enough to, kind of change things, kind of like this day right here. They both rallied, so you think, okay, here we go, like short, bullish intermediate confirmation signal, and now we rally. But then we continue lower to the point where the intermediate line declined. And so you wonder if that might be the case again this go around, if this day here ends up being kind of like what we saw on June 22nd, similar type of pattern. Because we're converging, you can see like after peaking here, what, 5% above pre-expiration at 5% above the 30-day moving average. We did have one more kind of exhaustion type peak on the last day of the quarter with that big gap higher and a big move, and we ended up over 3.5% above 30-day moving average, but we haven't been able to really push through after this pre-expiration peak, and as a result now we're only about 1 2/3% above the 30-day moving average. So we're we've been in this convergence mode and setting ourselves up for what we saw on Friday on the Dow Jones Industrial Average, this bull tag as we get closer to the moving average. Then any kind of short-term decline puts us into this bull tag. And again, bull tags typically start these bearish intermediate declines unless we bounce off of them. Now, you notice the last few bull tags have all had bounces, right? We had a bounce the day after that bull tag, and we still ended up with this intermediate pullback. We had a smaller bounce here after that bull tag. We still ended up with an intermediate pullback. And then we had a bounce up here for a couple of days after that bull tag, and we still ended up with a very shallow intermediate pullback there. When I say intermediate pullback, I mean anytime the intermediate line drops down in the bearish territory and we get dark pink shading and a red line up here on the chart. So just because we were up today on the Dow doesn't mean that we're still not susceptible to the beginning stages of an intermediate decline. Especially again considering that the S&P has been on this intermediate run now for 3 months, over 3 months now, and we're going on 4 full months for the Nasdaq 100. The Nasdaq 100 is just under 2% below, and it's a higher beta, so it's actually a lot closer to its moving average. So it's very susceptible. It's short-term sentiment, still in bearish territory, still got very strong intermediate posture market sentiment. So we're not, it's not like we're like about to tank. And the last bull tag we got was a good buying signal, kind of like a 3 red arrow buy signal here. But like I said, they also start these intermediate declines, and so we'll keep our eyes on when that might happen. The Russell 2000 actually looks the most bullish out of all the indexes. This short-term sentiment line exploded up into to bullish territory. 2 very good strong days in a row. As the Nasdaq approaches its pre. Now remember, it's everything else is kind of at this stage too. So the Russell is just kind of playing catch-up mode here. But because we had these 2 down days that were more bearish than what you saw on the Nasdaq or the S&P. So we are still flirting with that June pre-expiration high point. Breaking through that would be a significant development for the Russell 2000. Would be a very good sign. But again, we're still converging, and we'll see how this convergence ends up, whether it ends up into a consolidation or it ends up as a continuation pattern for these indexes that continue their way to the upside. So with the Hakinashi on the weekly chart, looking at the Hakinashi candle. So last week we talked about how we had a lower high point that makes us susceptible to a transition candle. We didn't get that. We never did get that transition candle here. So now we have another lower high point, slightly lower, even though we had a higher close on the Hakinashi close. That again, anytime you get a higher close but a lower high, that sets you up for a transition candle that could start an intermediate decline. So as of right now, this week, this would be considered a transition candle. It's a lower close, and there's an upper and lower shadow already on this. It'll depend upon where the close ends up being. The open will stay there, but the close will change. The close is an average of the actual open, high, low, and close prices. So the average of 4 values there. So we'll see if ultimately where that ends up. But as of right now, that would be considered a transition. It wouldn't be a very bearish transition because it's not a very bearish candle, which would suggest that you would probably get another transition candle. But the week's not over. The size of the candle is very small. It's well below its average. It's almost negative. So again, we're kind of last time we had that, it never did get negative, and we actually turned back higher for another run to the upside. We got these transition candles, 3 of them, before just turning back up to the upside and continuing higher. So we'll see if that ends up being the case here, or if we actually get an intermediate decline like we did, the last 4 times that we were in this scenario where the size of the candle dropped below its 3-period moving average, which is the purple line down there. You can see the PPO is pretty strong at 4.25% with the new weekly number. Again, that's the highest number since this whole correction started. So very, very bullish move from that perspective. The Russell 2000, remember how it's having a pretty good day today. It's obviously not at 4.5%. It's barely positive. We just had the golden cross. We've had 3 weeks of transitions. We have not closed above that body yet to negate that. And as of right now, you would consider this to be a transition. So we'll see how that ends up turning out. Your Dow Jones Industrial Average has also been in transition mode. It actually got a red arrow back to green here, but you can see transition candles. And as of right now, this would also be a transition because we're not below that low point yet either to reverse it to the downside. So that's what we're going to kind of keep our eyes on to see when we actually get some bearishness here. But you can see the signs of it in the Russell and the Dow Jones, the multiple weeks of transition that would suggest that we're heading in that direction. Let's look at the 3 green arrow chart, and you'll notice again we don't have 3 green arrows in the S&P because we got 2 reds there. We're back to 1 green arrow on the diamond. So we had the 3 red arrows that only stayed a day. That's actually a good sign. But the fact that we're still no shading at all on the S&P and the NASDAQ for so many days, again, and same thing here, we only had green shading for 2 days, same on the S&P. That's not what we want to see, right? We need to see longer periods of green shading and short periods of no shading to maintain the bullishness. And when you're getting longer periods of no shading and short periods of green shading, then again, that suggests that we're headed towards the pink shading, which is, extended period of 3 red arrows. And we're not there yet. The Dow is the closest, but they're getting closer as the convergence here lasts longer. And again, you can see the convergence period on when you break out the 2-line version, the MACD is below its moving average and falling. The average is falling too. I mean, that's the stochastics is falling below its moving average, and yet we're still above the 17 days. So we're still easily in convergence mode, where your convergence are still bullish. In this case, because the trend's bullish, convergence are still bullish. They're just lacking the momentum of the impulse move when, the initial surge higher, in this case, kind of another late surge higher. But the impulse move in the direction of the trend, the convergence is also in the direction of the trend. The consolidation, of course, would be in the opposite direction of the trend and wouldn't start until we break that 17-day moving average, at least on this chart, because that's the second number in the MACD that we're using. So still in convergence mode. You see that as well, like in the RSI and the CCI. They're not bullish, but they're also not bearish either. And then you look at the DMI indicators. The positive indicator is still below the ADX. The negative indicator is not nearly as bearish as it was. So again, convergence mode on that particular chart. We haven't had the crossover yet to suggest consolidation. And then you look at like the stochastics here below its moving average. But still in bullish territory, so it's convergence mode there. And then looking at like the Ichimoku cloud, it's still, we're still above 5, still above 80. You're actually still above the Tenkan line. Again, that's actually pretty bullish. You don't get convergence until you break that Tenkan line. And then the consolidation would occur when you don't have the trend anymore. So we're actually still doing okay on that particular chart. And then the Bollinger Bands, you can see we're not in the upper quartile so that we kind of need to be that if we're still in strong bullish mode, and we're not. The bandwidth is, we've been converging for long enough now that the bandwidth is almost back down those 150-day lows, and the bands now have moved inside the Keltner channel. So we do have the red dot. Again, would suggest again convergence, but an impending change to a new momentum. In this case, to the downside, as you typically get a change through the red dots from an extended period of green dots, you get a change to red dots. Again, we didn't have that here, and we maintained the bullishness, but of course you saw that happen here, and then back to the bullish side there. So that would be the expectation here going for the markets that we are in transition mode from that bullish impulse momentum move to this convergence period where we're lacking the momentum, but we're still maintaining the bullishness. It's just a grind to eventually the consolidation where you actually get the pullback to some degree, right? A weak pullback would be nice because we can maintain this long-term bullish move we've been having. A deeper pullback would throw the whole rally into question, right? And that's what we talk about with these Fibonacci lines. So the shallow pullback, if and when we do get our pullback, we would want that pullback to stop right around this 4,200 area. And you can remember, pullbacks don't start till you break that 23% retracement, which we would also be breaking the moving average in that case. And so that's when pullback starts. We haven't had right now this is just all noise right now. But you break that and we hold 4,200, keep it shallow, great. Then this whole bullish, that solidifies this bullish breakout move. Bounce off, hold that support and bounce off of it. But if we break back down towards below 4,200 towards 4,000, then now it starts to throw this whole move into fake out territory. It's like it never even should have happened, and that's a possibility. And in fact, I think that's the higher likelihood. But ideally, you'd expect support to hold until it doesn't, and if support can hold at 4,200 instead and bounce up, then we can maintain a good long-term bullish move, ideally up to 4,800 by the end of the year. As of course, it's the popular target of talking heads on TV is to get up to that level. And it was a popular target in 2022 to get back to that level as well by the end of last year. Didn't quite get there because of the NASDAQ 100 being as bearish as it was. But, you know, a 50% success rate, if you get it right this time, would be a pretty decent success rate. Let's take a look at the volatility now with the VIX. Volatility typically rises, falls on Fridays, rises on Monday. So it pulled back from the highs of the day, but it did rise. You notice we are above the 85% mark. So, you know, these different lines here act as resistance when we're below them, but then support when you get back above them. So as of right now, the 90% line is acting as resistance, but the 85% line is acting as support, and we are back above 15, and the VVIX is rising, the correlation's back up to stronger levels. The VIX is not at its seasonal lows yet. Its correlation with the S&P 500 has still been, you know, kind of slightly negative over the past 2 weeks. It's generally pretty strongly negative. So we haven't gotten back to that point yet, but you know, we have the seasonal low of the volatility index coming up here after the next 2 weeks. So, you know, typically this is a 2-week period of falling bearishness. So don't be surprised if we don't, you know, position ourselves to these lows. But as I mentioned before, with the consolidation that we've had, the compression that we've had in the VIX, and these correlations, these kind of rare correlations that are not normal with the VVIX and with the VVIX and the S&P, and then that ratio with the VVIX or the VIX3M, and this compression right here, and the seasonal low, you're setting yourself up for a pretty significant move in volatility. So one thing to go into a seasonal low, you know, with maybe a small low point, but considering how extremely low we are, it's really setting us up for the typical typical run higher in volatility that we see through the months of August, September, and October. It's not surprising today's range is really small. Here, sorry. No, let's do this one. Today's range was really small here. It was less than the average, just barely more than half the average, and the volume was small. So the typical summer day, but you know, ahead of an important CPI number that people are kind of waiting to see just how down it will be. I mean, it's expected to be down, expected to bring this year over year down. But now the question is, you know, is this the last time the year over year goes down? I mean, we've been on this very long streak of the year over year figure dropping. It's rare to be that long, and is this going to be the last one? So I think people are going to look, more people are going to look past what this actual result is, because we've been expecting it for so long, and now starting to figure out what's it going to be like. Once we go back up, how far back up are we going to go? And again, that number starts in August too. So also the August release of the July figures will add to the potential volatility depending upon how much we do ramp back up. You can see as of right now, the Cleveland Fed, here, let me bring the Cleveland Fed up here. The nowcast for the Cleveland Fed, you can see is showing a 0.42% result month over month here this week. That would bring it down, the year over year, down to 3.22. But as you can see, you know, with the following month expected to be at 0.34%, that would start to raise up our year over year figure. And that's, I think, the last thing people want to see, because at 3.61%, while it doesn't seem like that's a strong number, when you look at it, 3.61%, even at 3.22, but at 3.61% level, just to kind of show you where that lies on its average or over time, you can see that's a strong year-over-year result. I mean, that's a high level of inflation that in the past has sparked rate hikes, and more than likely will spark more rate hikes, as obviously we're widely expected to get a rate hike here in July at the end of the month. Again, that FOMC meeting happens to coincide with that seasonal low in volatility this year, but we're widely expected to get a rate hike there. The question will be, what are the odds that we'll get that second rate hike up to 5.75, or which right now is 30. That will be there by the end of the year is 33%, or even all the way up to 6%, which is low odds now, but I mean even at 32% combined. And that's down a smidgen from where it was yesterday. It was only 5% a month ago. So that, we're continuing to get some strong high odds. Like this is the July or December figure. This is the 5.5% here that we're expected to get to, or that we're expected to hike to here at the next month. That gray line, you can see it's back up to above 80% and staying there. So again, high likelihood that we'll be there by the end of the year. And we're looking at about 90% odds that we'll be there. And even this one, the green line, which did spike up to 60% briefly before dropping down before the financial crisis, you can see is right back where it was right before that spike. And that's again, 2 more rate hikes by the end of the year, with the third one being down here in orange up to 6%. So that's all coming, right? That's part of the volatility picture that we have coming up for the S&P 500. All right, now let's take a look at what's driving a lot of this price action. We'll take a look at our asset comparison chart here. Just a second to load up. So you can see again, the Qs remain the big winner over the last 3 months. IWM starting to catch up a little bit. It's been lagging behind the S&P, now has outpaced the S&P for the 3 months after a brief period of outpacing it over here for this 3-month window. Long-term bonds, after a big down week last week, are your biggest loser. If you look at just today, remember today was a relatively quiet day for the markets here. You'll notice eventually. There we go. So IWM had, it was the biggest outlier in a big way today, up 1.68%. Everything else was relatively flat. The dollar was actually the biggest mover, and that's actually a pretty decent size move for the dollar index. Everything else flat to no gains at all. If you take a look at that move in the dollar index, as bearish as it was here, get this up here. And there's the dollar move. So you can see it's been on this bearish decline. There we go. It's been on this bearish decline, and really after an up and down day, following up Friday's down move with more of a move here. You can see its MACD and stochastics are down. This is actually a bullish sign for the markets if the dollar can maintain this bearishness. It's again it's still in a range, so it's not like it's breaking out of these lows. The weekly MACD and stochastics are both falling, though not, again, the MACD itself has already had the bulk of its decline, and still in between its 15-200-day moving average is sitting at the 50% retracement of its rally that it's had. Remember, typically after the dollar makes a rally, long-term bonds will follow suit. And remember, that pattern hasn't developed yet. So as the dollar made that rally, it's typical for bonds to fall. Not to this degree. This is probably the largest degree. But then bonds start to rally after dollars made their move, the bonds make their move, and then stocks make their move after, because stocks are typically bearish during a bond rally. We haven't had that bond rally yet after a big decline, as I mentioned, the lowest close of the year, going all the way back to over here. We closed at 99.56, and last week closed at 99.08. So, this is the lowest close we've had in a while, but still, you can see, like, we're not extending away. We've already been on a little bit of a decline. We're right around the point of control. We've had, again, the bulk of the bearishness. You've seen the bulk. There's the histogram bottoming out. The MACD bottomed out over here. It's unlikely that we'll bottom out at that point or lower. So any kind of low we get lower than this will probably be just a divergent low point. As the lines are, there's a pretty sizable gap. In fact, that is the biggest gap between the 50 and the 200 week moving averages that this ETF has ever had. Right? If I were to go back out, That's the biggest decline that's ever had. 23% is about as big of a decline as the peaks. I mean, that it's the biggest peak it ever had was this rally up during from the fourth quarter 2018 through COVID. That was the biggest. This kind of fake bear market that we were in, that the mega cap names kept us from experiencing on an equity level. So yeah, you notice here that like that's a pretty deep low, and when bonds make the move to fill in that gap, when they make these runs, you wouldn't expect it to be a bullish move. Again, it's more of a risk-off move when bonds make that rally to the upside, unless we maintain the inflationary environment we're in, where bonds and stocks can both go higher. In which case, we do get that rally to the end of the year, the Tom Lee rally to 4,800 that he's been calling for since the middle of last year. So we do get that, but with inflation rising, rising again, not falling, and more than likely rate hikes up to 6% or higher by the end of the year. So that's something to keep an eye on. And like I said, the dollar, I wouldn't put a lot of stock in this dollar move until we see more of a decline, more significant break below, this kind of 100 level, which is a pretty obvious level of resistance, plus or minus a few points here, but I guess it'd be like maybe 100 and a quarter, but you can see there's multiple touches in this spot, and we'd have to really break down below that if we're going to continue with the bear, which is typically very bullish for equities, as you saw in 2017, as well as in 2020. These big sharp moves lower, the impact it has on risk appetite in general. Let's take a look at how the sectors performed today. So remember, it was a small cap day today. That was the biggest mover, really the only outlier aside from the weakness in the dollar, the only outlier that we had. Let's take a look at the sector performance. And you'll notice the biggest outlier was industrials, which has been associated with the Russell 2000. Of course, these are all S&P sectors, so it's not the Russell 2000, but they're correlated, those smaller weighted sectors in the S&P 500. Healthcare rebounding after a really bad week, really bad period of time here lately, and then energy also doing well, financials. So again, the cyclical area that's not, XOK into Qs, right? The Qs lagging behind because of this rebalancing news that came out that talked about how they're going to shift the number. If you look at here, let's go to this one. We'll go to the S&P, the NASDAQ 100 names. They typically, when the top stocks get to a certain concentration level, then they have this mechanism where they bring everything back down to a smaller degree, and that happened today. It looks like the site's not coming up here, but that happened today on the NASDAQ 100, and these 7 companies make up a large percentage of the NASDAQ 100, which itself makes up a large percentage of the S&P 500, and so they're going to redistribute some of that weighting to some of the other stocks in the index out of those names, those 7 names, and that's going to put pressure. Not surprisingly, you can see utilities and staples, which are not sectors you typically see alongside technology and communication services, but they also were underperformers. So a risk on day, but not your typical risk on day, led by the big move, the big movers, which have been, they're the ones that have been leading over the past few months. You saw the Qs and how they've been doing. That's pretty much these top 3 sectors at the top. Well, those top 3 sectors at the top were some of the weaker sectors today, whereas look, you can see industrials really breaking up, financials near its 3-month highs, and energy getting close to its past month high, real estate doing okay, and you can see some light pink shading. So we're not dark green shading and green lines across the board, but for the most part we are. And again, it's a good sign considering when you look at the implied correlations within the S&P 500, like basically how all these stocks are correlated with each other, they're at their lowest levels in multiple years. Going into the last time we had it was going into the early part of 2018, where we were also pretty parabolic in the S&P, and we kind of started a period. 2018 had multiple corrections, and of course the correction of 2020, and the mid-cycle adjustment of 2019, which halted another pullback there where the Fed started cutting rates early. That started a pretty decent period of volatility, and that's what we're seeing now. Correlations among all these sectors are low. They're not moving, at least the components within the sectors are not moving in conjunction with each other. So you can see this page did finally come up, and you see the top components. Meta is the only one that really had an update today, but everything else down. See, everything else within the NASDAQ 100 is bullish, right? There's just a handful of companies that were down today. One, two, and it looks like a couple of utility companies, Exelon and Xcel Energy, and Dr. Pepper was down today. Mercado Libre was down the most. But outside of those, the only other components in the NASDAQ 100 that were down were the biggest components. And, again, two of them by themselves make up 25%. And then, like I said before, combined, they're making up a huge number. These 8 companies making up a huge, when you add all of these up, and even Broadcom, which has been an AI play as well, making up a huge percentage. You're the top 8 companies, which would include 2 Google shares. That's why we're going to 8 instead of just 7. But 55%, that's a big number. You're at top 5 companies, you're at 43.8, and they had hit that 45% number, which is what triggered that mechanism for the NASDAQ 100 to start to pull things back, and that's, their declines today brought us off of that number, but they're still, it's a pretty high weighting when 55% of your index is 8 companies and the other 92 make up 45%, and really it's even, it gets worse because your top 20 make up 70% and your other 80 make up 30, so it's a pretty top heavy index, and it's having, while it's going to impact the NASDAQ 100, this weighting rebalance, it's not going to impact the S&P because they're not going to change it. The S&P, you can see it's still 28% of the index is made up of these 7, magnificent 7. And then you get to, your top 35, you're pretty much at 5%. And 465 or 50%, excuse me. The other 465 make up the other 50%. So a big top heavy index, that the NASDAQ 100 has got a mechanism to shift the weighting, but the biggest mechanism to shift that weighting of a concentrated index, because this is not the first time we've ever been concentrated at the top. The market's mechanism for breaking up that weighting, that concentration, is a bear market. And so we'll see if that's what ends up breaking this one up here sooner rather than later. All right, now let's take a look at our trade idea of the day, and we'll take a look at Twilio here. After a nice little rally, big post-earnings move up, an initial knee-jerk to the downside, but then a big post-earnings move up to the upside, peaking at about 29% above the 30-day moving average, but it has since gone sideways. Has not barely breaking below the 23% retracement line last Thursday, getting the bull tag in the process, and then still maintaining the bull tag here over the last couple of days, light pink shading and the yellow line, even though we were relatively bullish here today, almost 2% higher. Short-term sentiments bouncing, but the long-term, the market sentiment, the intermediate posture is weakly bullish. In fact, it's bordering on now kind of more neutral than it is bullish. When you take a look at the long-term view of the chart, you can see it had been strongly bearish. From a long-term perspective, it's really been consolidating pretty much over the past almost year now. We've been consolidating right kind of around these levels. The PPO has been rising, still in negative levels, minus 10%, but at least much better than where it was at 45% lower between those gaps. And this last kind of move here on the candles getting bearish did not get very bearish at all. It's kind of the weakest bearish move we've had. So it seems like the bulk of the weakness is behind the stock, and now we have it has potential of moving up to the upside. If you look at the 3 green lines, you can see we're trading below the 30-day moving average. We are sitting right around the point of control for the year, trading in between the 30 and the 50 and 200 day, which are kind of on top of each other right now. So you got the consolidation, like we've been below the 17-day barely, but we have been converging for so long, and now we've got a slight consolidation, but right around the point of control, so not a whole lot of movement there. When you look at the DMI, you can see even more consolidation here as both the positive and the negative indicators are both below 20. You see how rare that is. Like we had that move over here before earnings. We had them both, and we had the breakout move to the downside with the ADX is at a very low level as well. This time the ADX is still actually falling, so we still have potentially more consolidation actually left to come on this. Looking at the, let's see, that was the, if you look at the RSI and the CCI, this one here, you can see they're also both right around, the RSI at least around its midpoint. The CCI did not really break to bearish levels here last Thursday, so it's at the low end of its bullish range, but it's not breaking down to bearish levels. It's Ichimoku cloud. You can see you're still above the cloud. You are below the blue line. The green line's below the blue line, so we've really consolidated, but there's no significant trend either direction right now, one way or the other. And then finally, when you look at the Bollinger Bands over here, there we go. The Bollinger Bandwidth is really light too. It's come way down after that big bullish move. We're centered right on the point of control, and the bands themselves are well inside the Keltner channels as we've transitioned from bullishness to bearishness through those red dots. But it doesn't look like, as of right now, we have the potential move to the downside. We've had our move to the downside now. We could just stay kind of in this mode of sideways action, even with earnings coming up here after this July expiration before August, which is what we're looking at here, is an August iron condor spread at the low 20 deltas, buying one strike away. You notice I only got a couple contracts on because I'm able to get a pretty decent reward with the earnings risk, with a smaller risk than what we normally take to get that reward. And you notice those break-evens, that's where our break-evens are. If we get to the break-even to the top side, we're going to have a very significant breakout move to the upside. And if we break it to the downside, you can see we've got some Fibonacci support that would be holding us up around that break-even. So it would take a pretty significant breakout, basically refilling this gap again to the downside there and working on this gap, this other earnings gap that I had. So it can have some pretty volatile earnings, as you've seen, though it doesn't, after it makes the earnings move, it doesn't really extend, right? It tends to knee-jerk reaction. And this one went up and down, this one went down, went up. Here we went down, then up, and then over here we went up and then down. So, assuming that we get a down move towards support on earnings, you're more than likely going to find some support in that area and then work your way back towards the point of control, which is the point of the trade here. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.